I'm sure that none of you do because the income limitations are fairly high. And as long as you're able to put money into a Roth IRA, you should. Now, there's a couple of things to consider. Number one, does anyone know what you have to have in order to make a contribution to an IRA? Yes? Earned income. Okay, it doesn't count. Allowance is not earned. You have to earn it. Even though you think, you know, making your bed or whatever your chores are that you get paid for, that doesn't count. Okay? It has to be earned income. And you can contribute as much to a Roth IRA as you earn in the form of income over the course of the year. Okay? So if you mow lawns and if you babysit or whatever it is, if you have $600 of income over the course of the year, $600 should go into a Roth IRA right now. Well, then you say, well, but that's I need that money to, you know, that's my spending money. I can't put it into an IRA. So talk to your parents and say, listen, this is a really good retirement vehicle, and I really believe that I should be saving now. I'm paying myself first, and I made $600 this year, so I can put $600 into a Roth IRA, but I don't want to put my $600. Can you do it for me? Okay? And I bet you, if you have this conversation with your parents, I bet you almost all of them will put at least some of it in if they can. Because here's their, you know, 9th and 10th grader telling them that they're trying to pay themselves first and save for retirement and be very responsible, and then you just follow it up with a give me some money. I'm telling you, it's going to work. Yes?
You were saying that, say you mow lawns and you earn $600.
Right.
How do they know that that's earned money when you go to the IRA?
Because you report it on your tax return. So keep track of the money that you earn. And don't worry, the first $1,700 that you earn isn't going to be under 14. How old are 9th and 10th? Okay. It's very unlikely at your age and income level you're going to actually pay any taxes on it. But you have to report the income that you earn on a tax return so they know that you have earned income so that you can take advantage of making a Roth IRA contribution. That's a great question. Okay? So if you can start that now and you look at that $2,000 a year, how quickly it's going to grow and compound, because not only now are you making interest on interest, but you're not paying any taxes on that money. It is a win-win. I mean, if you have an option when you start working, okay, you're going to have a 401k plan, and hopefully you're going to be able to contribute to a Roth IRA, depending on what your, well, maybe not hopefully. If your income is over well, if you're single, if your income is over about $110,000, you won't be able to contribute to a Roth IRA. So I guess hopefully you won't be able to contribute to one, right? But if you don't make quite that much and you can contribute to a Roth IRA, if you have a choice between a 401k contribution and a Roth IRA, what do you think you would do? Why 401k? Free money. You've got to put at least enough into the 401k plan to get that free company match. The next $2,000 that you have, and actually it's not $2,000, it's $4,000, goes into the Roth IRA. And then if you happen to have more money, then you put more into your 401k. Yes?
What's the difference between a Roth IRA and a 401k?
What's the difference between a Roth IRA and a 401k? There are a couple major differences. Does anyone have an answer to that question? Yes?
Well, the company's not going to be like putting in money into your Roth IRA.
Company doesn't put money into a Roth IRA. What else? Yes? You can't get a personal 401k. You have to be employed through a company. That's actually not totally true. If you're self-employed, you can set up something called, and you work just on your own, you can set up something called a solo 401k, actually. Okay? Yes?
A Roth IRA isn't taxable. It's tax exempt.
Correct. A Roth IRA is tax exempt. A 401k is tax deferred. Meaning, the money that goes into a 401k, eventually you must withdraw it, and you have to start taking money out of a 401k at age 70 and a half. Okay, that's called minimum distribution age. When you start taking money from a 401k, it's taxed. So you're going to pay taxes on that money. When you start taking money from a Roth IRA, the other difference is you never have to take money out. So if you're fortunate enough that you have millions and millions of dollars and you don't need it, you don't have to take the money out. But if you do start taking money out, there's no tax. Okay, what's the other major difference? Yes?
I have a question.
Okay.
If you have to get it from your company, what happens when you switch jobs?
Good question. If you set up a 401k with your company, what happens when you switch jobs? Let's just answer that question in a minute. I just wanted to say the one other difference before we get past this topic of making a contribution to a 401k and a Roth IRA. What's the tax consequences of the two? Does anyone remember what I said? When you make contribution to a Roth IRA, do you get a tax deduction? No. But you do get a tax deduction when you make a contribution to a 401k. So it reduces your taxes when you make a 401k contribution. It doesn't with a Roth. But when you're talking about the kind of time you guys have, as young as you are, it definitely makes sense because you have all these years where you're not paying taxes, plus you don't have to pay taxes when you take a distribution. So that answered your question? Okay. Back to the question of what do I do when I change jobs? What do you guys think? Yes?
Some are transferred over. Some companies cooperate with each other.
Transfer it over. Meaning, okay, I went from company A, 401k, to company B. Company B has a 401k plan. I can do what's called a direct transfer from company A to company B 401k plan. So you roll it over, and it just, you have $10,000 in company A, you roll it over into company B. But there's a couple of other options. What do you think you could do? Yes?
Possibly could you take it out right there?
You could take it out right there. Would you take it out right there?
No.
What would happen?
You have to pay tax out.
Pay taxes. What else do you have to do? Penalties. You've got to pay 10% penalty plus taxes. Plus, that money that was sitting in this tax-deferred environment that was going to be in a place where you never had to pay taxes on it until you start taking money out, it's all of a sudden becomes taxable again. Okay? So please, another most important lesson, write this down. Don't take money out of your 401k plan. Roll it into either a new company 401k plan or roll it into an IRA. Think we need a break? Okay. Meaning put it into an individual retirement account, which is the other option. Why would you choose that over rolling it into another company's 401k plan? Yes?
The other company's 401k plan is worse than, less beneficial for you than for these.
Okay, the answer he gave was the other 401k companies, the other company's 401k plan is less beneficial for you. For example, the investment options aren't very good, or the investment options are very expensive. You're not going to want to put your $10,000 there. You can take your $10,000, put it into an IRA, and you can decide what investments you want to choose. Okay? The other thing is, if the balance is over $5,000, you can leave it in that company's 401k plan. But you may not necessarily want to do that because it just kind of gets messy. I have some clients who have 6 different 401k plans from employers they worked for 25 years ago. And you can roll them all into one IRA and have one account and not have a ton of different paperwork. It just simplifies things. Is a mutual fund considered income or growth investment? Growth investment. Look at page 33 in the book. There's figure 3.2, financial planning pyramid. Okay? The first, the foundation of this pyramid, savings and checking accounts, U.S. savings bonds, certificates of deposit, treasury issues, those are all considered income investment. Do you think you're going to get a high rate of return from income vehicles or a low rate of return from income vehicles? Low, because we're not taking on really any risk, right? So as you go up this pyramid, you're taking on more and more risk. So what does that translate to in terms of return? Yes? Hopefully higher. Hopefully higher. Okay, not always higher. Remember, you could have your money sitting in a money market account making 5%, very comfortable, and you can put your money in the stock market because you're going to try and get 10%. But what if the stock market tanks that year? Are you going to make a higher rate of return on the investment that you're taking more risk in? No, you're going to make a lot lower. But over longer periods of time, you're hoping that you will make more money, right, taking on more risk. So if you go up this pyramid, you can see you go from the U.S. savings bonds to high-grade municipal bonds to mutual funds, real estate, okay? Collectibles, it gets more and more risky, and hopefully higher potential rates of return as you go up the pyramid. Okay, so what's